Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. All right, today we are jumping right into something pretty significant in the enterprise software world. We've been looking through materials from a major company's investor day back in October 2025. And this wasn't just about numbers. It was really the big reveal of a whole new architecture, a transformation built around this idea they're calling the Agentic enterprise.
Yeah, and what jumps out immediately is the sheer scale of this shift. It's not just a new feature list or some marketing spin. They spent 4 solid years laying the groundwork, re-architecting the platform, and then on top of that, a really intense 2 to 3 year push specifically to embed advanced AI, generative AI, agentic capabilities across, well, everything.
That's a massive commitment, years of work. So for the listener, for you, our mission today is to really pull apart the layers of this new Agentforce platform. We want to explore how it technically works, what critical lessons they learned, the hard way probably out in the field deploying these early agents, and maybe most importantly, how exactly they plan to monetize this whole thing, this huge shift to hit their, pretty ambitious long-term financial goals.
Makes sense. And maybe we should start with that 4-year foundation. Because understanding the problem they were trying to solve before, say, 2021 is really key to grasping why they were, maybe surprisingly, so well positioned when the AI revolution kicked off in earnest around 2023.
Okay, yeah. The sources are pretty clear on this. For the first 15 years or so, their success was really built on that core multi-tenant cloud CRM, sales, service, the platform itself. But then as they grew, mostly buying other companies to add capabilities, they ended up creating a big internal headache: fragmentation.
Right. And fragmentation, it just creates friction everywhere. I mean, the whole point of CRM is supposed to be building these lasting, personalized customer relationships, putting the customer right at the center. But when you've got like 5 or 6 different systems, different code, maybe different databases, that customer experience gets chopped up. It's siloed. The employee experience is siloed too, people clicking between different screens. And crucially, the data gets siloed.
Which defeats the whole purpose.
Exactly. If your sales team doesn't know what service did, and marketing can't easily see either of those interactions, you just can't deliver that truly personalized one-to-one experience. The whole CRM promise kind of falls apart under its own weight, architecturally speaking.
So the big push, starting around 2021, wasn't really about adding flashy new features initially. It was more about internal housekeeping, getting everything unified.
That's it, precisely. The goal was to bring every single application onto one common next-generation platform. And the first big focus, really kicking off around 2022, was consolidating the data. They saw that data was the absolute foundation. For CRM, yeah, but also for automation, for analytics, and critically, as it turned out, for AI. This massive effort to fix their own data fragmentation directly led to them building Data Cloud, which they're now calling Data 360.
So it sounds like they were essentially paying down technical debt, fixing their internal plumbing, and almost accidentally built the perfect on-ramp for generative AI.
That's the really fascinating part. You hit it exactly. The hard work needed to unify, secure, and govern all that messy, disparate data for basic CRM needs. It turned out to be the exact kind of infrastructure you need to effectively ground large language models. So they were solving their immediate architectural problems, and then boom, suddenly they had all the right pipes in place when the Gen AI wave crashed over everyone in late 2022.
Right, the chat GPT moment, as everyone calls it. How fast did that realization hit internally? Did it cause a scramble, a pivot?
Oh, it was immediate
Uh-huh.
and profound. Based on what we're seeing, the company pivoted and pivoted fast. They understood their edge wasn't going to be building a better LLM than, say, Google or OpenAI. Their unique advantage was integrating those LLMs, activating them for the enterprise, making them useful and safe within business processes. So they went from embedding fairly simple prompts to building out full agentic capabilities really quickly, which led to the Agentforce launch about a year ago, which got a lot of attention.
And what was the initial reaction from customers? Because, back then, a lot of businesses were still looking at LLMs as interesting toys, maybe, but not core infrastructure.
The validation was honestly pretty staggering. Within just the first few months after launching Agentforce, they had over 12,000 customers actively in there building and trying out agents on the platform.
Yeah.
That kind of rapid uptake really suggests the enterprise market was just starved for a solution they could actually trust, something governed and integrated.
Okay, but deploying at that scale, 12,000 customers trying things out, that must have immediately surfaced all the rough edges, the operational challenges. What was the biggest lesson, the sort of hard-won truth they learned from those initial deployments?
Yeah, the core lesson they kept emphasizing, this is really vital for you listening to grasp, is that LLMs by themselves are basically useless for actual business processes.
Yeah.
Sure, they can write a nice email or summarize a long document, but in the actual flow of work, they're kind of blind and uncontrolled. To be truly effective, truly reliable in an enterprise setting, these agents absolutely must be connected, deeply connected, to 5 essential pillars. You need accurate business data, you need the underlying systems to actually do things like create a case or process an order, you need the core business applications, and maybe most critically, you need enterprise-grade security, sharing rules, and governance wrapped around the whole thing. If you miss even one of those connections, the agent is either unsafe, unreliable, or just flat out can't do the job.
Okay, so that core lesson, LLMs need data, systems, apps, security, governance that really drives the whole technical design they landed on. Let's break down those 3 layers of the Agentforce 360 architecture they presented, starting right at the bottom, the foundation. Layer 1, the data layer, which is Data 360.
Right. And the first thing we need to clear up here is a really common misunderstanding. Data 360 often gets talked about like it's trying to be another Snowflake or Databricks, another data warehouse. That's completely off base. In fact, Snowflake and Databricks,
Yeah.
they're actually major partners.
Okay, so if Data 360 isn't replacing the big data lakes or warehouses that companies have already invested millions in, what is its actual function? What makes it so essential in this stack?
Its job is really about activation and harmonization. Because Data 360 is built right into their common platform, its unique value is allowing businesses to bring together all their customer data, not just the data already in Salesforce, but also web clickstream data, mobile app interactions, crucially, data from back-office systems like ERPs. And it consolidates all of this into one unified, secure view, what they call the single golden customer record. It acts like the central switchboard and, importantly, the governance layer for all that customer data.
And the key technology enabling this, the thing that sounded really powerful, was this zero-copy data federation. That sounds almost like magic. What does that actually mean in practice? What does it let a customer do?
Yet, zero copy is a bit of a game changer for data access. It completely changes the old way of doing things, the economics and the speed. Think about the traditional approach. If your marketing team needed customer purchase history that lives in your main enterprise data lake, say it's sitting in Redshift or Databricks, getting that data into the marketing cloud usually meant a complex ETL job, extract, transform, load. You're physically copying the data, processing it in batches, maybe overnight, and loading it into a separate marketing database. It's slow, it's expensive, it adds latency, and the data is immediately stale.
Right. And what if you needed that data updated like every hour or even faster?
Exactly. The batch process just breaks down. Zero-copy federation flips that script. It essentially virtualizes the data. With just a few clicks in Data 360, you set up a secure, governed connection to that external data lake, like Snowflake or wherever the data resides. The data stays put, it doesn't move. But Data 360 makes it immediately visible, queryable, and this is the critical part, actionable right inside Sales Cloud, Service Cloud, Marketing Cloud, wherever the user or agent needs it. So you eliminate the cost and complexity of moving data around. You slash the latency down to near real time, and you get rid of all that engineering overhead tied up in maintaining ETL pipelines.
So the pitch to the customer isn't rip out your existing data lake and buy ours. It's more like, we can help you unlock the value of the data lake you already have, make that data live where your people actually work.
Precisely. It bridges that gap between where the data is stored and where the employees and now the agents need to use it to do their jobs. And another key thing they had to enhance in Data 360 was handling unstructured data. PDFs, documents, emails, even things with flowcharts in them. This stuff is vital context for agents, but it needs a lot of specialized processing before an AI can make sense of it.
Okay, that makes sense. That data foundation brings us up to layer 2. The agentic layer itself, Agentforce. The materials talked a lot about the journey from making cool, killer demos to achieving real enterprise reliability. The first big hurdle they hit was something called the prompt doom loop. What exactly was that?
Right, the doom loop. It perfectly captures the frustration engineers were having. They were trying to get these LLMs, which are fundamentally probabilistic, designed to predict the next likely word, to follow very specific, rigid, multi-step business rules. Think about a complex compliance check, right? Like, if the customer is in California, you must present disclosure A, then perform check B, but under no circumstances should you process payment method C without explicit verbal consent.
Hey.
You give that instruction to a standard LLM, and because it's probabilistic, it might follow it perfectly one time, slightly differently the next, and maybe miss a crucial step the third time. It doesn't really understand transaction boundaries or guarantees. It fails the repeatability test needed for serious business processes.
So customers and developers were basically wrestling with the AI, trying to force it to be consistent through really long, complicated prompts and getting unpredictable results.
Exactly, just getting tangled up in prompt engineering, hoping for the best. And in regulated industries like finance or healthcare, that kind of unpredictability is just a non-starter. It's a massive compliance risk, a legal liability waiting to happen.
So the solution they engineered was Agentforce script, which allows for deterministic execution. How does that work? How do they blend the creative power of the LLM with the kind of certainty you need from software?
This was probably the most crucial architectural decision they made. The big realization was, look, if there's a part of the process where you know exactly what the agent must do 100% of the time for compliance or just basic process flow, then don't rely on the LLM's fuzzy probabilistic reasoning for that specific step. Agentforce script lets developers embed traditional, reliable software logic, think standard if-and-else conditions. The kind of process automation the platform has supported for years directly into the agent's brain or execution path. So, the LLM might handle the more ambiguous parts, like understanding the customer's intent from an email or summarizing a case history, but the agent for script handles the critical deterministic steps, like updating the right fields in the database or calling an external system via an API in a precise sequence.
Okay, so it's like using the LLM for the thinking and understanding parts, but using proven, reliable code for the doing and acting parts, especially where rules and compliance matter most.
That's a perfect way to put it. It gives you that essential repeatability. Now, the second major technical hurdle they discussed was accuracy, especially when agents needed to understand complex, unstructured documents.
Right. The materials mentioned that initial attempts, just feeding raw documents like PDFs into LLMs, were only getting around 40% accuracy, which is not great. Basically a coin flip.
It's unusable for most real business tasks. Imagine a complex PDF. Maybe it's got text, but also a flowchart explaining a process, a nested table with product specs, and a summary section. If you just dump the raw text extraction of that whole document into an LLM, the model often gets confused. It struggles with the layout, the relationships between different parts, the hierarchy of information. It doesn't understand the visual context. That leads to inaccurate answers or misinformation, forcing customers to spend huge amounts of time and effort manually pre-processing or cleaning up the data before the LLM could even touch it.
So how did they fix that? How did they get from a dismal 40% up to what they called the high 90% range in accuracy?
The solution was something they called intelligent context. They realized they couldn't just treat unstructured data like a simple text blob and throw into a vector database. Instead, they completely re-engineered the data pipeline within Data 360, specifically for unstructured content. They use AI itself as a pre-processing engine. This engine analyzes the document structure, identifies things like tables and flowcharts, understands the semantic meaning of different sections, chunks the information intelligently, and extracts key metadata. It essentially creates a much richer, highly structured, context-aware knowledge base from the messy document before the agent even needs to ask a question about it.
Ah, okay. So the agent isn't querying a raw PDF dump anymore. It's querying a pre-digested, structured, contextualized version of that document, which makes it much easier for the LLM to find the right answer accurately.
Exactly. It dramatically improves the quality of the information the LLM receives, which directly translates to much higher accuracy. And alongside these core improvements, they also rolled out things like low-latency voice interaction, making sure agents can talk naturally with humans and handle interruptions, plus an AI-powered builder tool to help customers create and deploy these agents much faster.
Which brings us to the final layer, layer 3, the agent force applications. This is where the rubber meets the road, right? The entire product suite, sales, service, marketing, commerce, field service, analytics, all the industry clouds rebuilt to be Agentforce enabled.
Yes, and the key here is that it's not just siloed agents within each app. Because they're all on that common platform with Data 360 underneath, the agents can work together seamlessly. So an agent working on a marketing campaign might identify a hot lead, which then automatically triggers another agent in Sales Cloud to create an opportunity, which might then prompt a service agent to check the customer support history, all using that same unified data record.
Let's talk about some specific examples they gave. The sales application they highlighted, SDR, sales development rep, agents tackling a big inefficiency.
Yeah, the SDR use case is really compelling. The data apparently showed that human SDRs often end up ignoring a huge chunk of incoming leads, maybe as much as 75%, simply because the perceived value isn't high enough to warrant the manual effort of following up. So now, they're deploying these Agentforce SDR agents to systematically follow up on that long tail of previously ignored leads. They can nurture them, qualify them, and in some cases even autonomously close deals. It's basically tapping into a massive tool of potential revenue that was just sitting there because it was too costly to pursue manually.
And the service application seems focused more on augmenting human agents, right?
Service is a great example of human-agent collaboration. You have agents helping the human staff in the contact center, maybe suggesting answers, summarizing long case histories instantly, ensuring a smooth handoff if an automated agent needs to escalate to a person, making sure all the context transfers. They also provide that instant expert support for field service technicians out on a job site. Imagine a tech needing info on a specific part or procedure. The agent, powered by Data 360, pulling real-time info, can provide it instantly. And the overall result, when you have agents working across sales, marketing, and service like this, is that those traditional departmental lines start to blur. You're finally achieving that original CRM vision. Truly personalized one-to-one conversations, but now delivered consistently and at massive scale. It's fulfilling, as they put it, the dream of CRM.
Okay, so the technology is impressive, the potential seems huge, but now we get to the really critical part. How do they actually plan to make money from this? How do they capitalize on what they're calling the golden decade opportunity?
They're framing this transition as being just as fundamental, maybe even bigger, than the shifts from on-premise software to the cloud that dominated the 2D10s. The idea is that basically every company, every organization now feels pressure to become an agentic enterprise, using AI agents to drive growth, unlock major productivity gains, and deliver way better customer experiences. The potential market size is just enormous in their view.
That kind of ambition needs a new sales approach, right? A different way to talk to customers. What's the new sales motion look like?
It's definitely more consultative and very industry-focused. The process usually starts with developing a specific point of view tailored to the customer's industry. So for a telecom company, they might come in with a roadmap outlining, say, 80 specific agentic use cases relevant just for telcos, things around network operations, customer retention, new service activation, etc. But a really crucial part of the approach, and this seems smart, is respecting the customer's existing IT landscape.
Meaning they don't storm in demanding the customer throw out everything they've already built?
Exactly. The message isn't, you need to rip out that data lake you spent 5 years and millions building. It's more like, hey, we respect that investment in Redshift or Databricks or Snowflake. Data 360 doesn't replace that. It actually multiplies the ROI you get from it by activating all that data that's currently locked up, making it usable in the daily flow of work. That kind of message makes the C-suite, especially the CIO and CFO, much more open to the conversation from the start. And given that agents are touching core processes, pilots are pretty much essential. Customers need to see it working, prove the agent can operate securely, reliably, and fit within their own specific compliance and governance frameworks before they commit big.
Okay, so once the value is proven in a pilot, let's talk about how they actually structure the deals. They mention a flexible commercial construct. How are they packaging and selling Agentforce?
They've got a few different ways, really designed to meet customers where they are in terms of certainty and expected usage. The most straightforward model is probably the seat-based editions. Think about Agentforce for Service, for example. If a customer has, say, 10,000 human service agents using Service Cloud, they can upgrade those 10,000 seats to the new Agentforce edition. This gives those human employees unlimited, unmetered access to use the agent capabilities designed to help them, the co-pilots, the assistants. It significantly increases the price per seat for that existing SecC, adding the agent value on top. Right, that covers the licensed human workforce. But what about customers who are maybe still experimenting or want to deploy purely autonomous agents that don't map one-to-one with a human seat, or they just aren't sure how much they'll use yet? That's where the second approach comes in. Consumption models. This is often based on what they call fuel credits. It's basically a pay-as-you-go model, or customers can pre-commit to a certain volume of consumption. This offers a lot more flexibility. It's great for customers who want to start smaller, maybe with a few autonomous agents handling specific tasks, or for those who are still figuring out exactly how and where agents will provide the most value and what the usage patterns will look like.
And then there was a third piece, the flex agreements. This sounded like it was designed to address a potential fear from the customer side, right? Specifically, the CFO worrying. What if these agents are so good we end up needing fewer human employees? Are we stuck paying for seats we don't need?
Yeah, that was a pretty savvy commercial move. It directly addresses that perceived risk. The Flex agreement essentially gives customers reassurance. It allows them, if they do end up rationalizing some human seats because agents have taken over certain tasks, to convert the value of those now unused seat licenses into consumption credits, into that fuel for running other autonomous agents. Now, the company was very clear during presentation that widespread human seat reduction is not happening in a major way. Yet they see agents mostly augmenting humans or tackling work that wasn't getting done before. But having that flex agreement in place provides crucial confidence and financial predictability for the executive team signing the check.
Okay, makes sense. Now let's talk about what sounds like the main engine for really big deals, the accelerator. The Agentic Enterprise License Agreements, or AELAs, sometimes they call them ILS too. This seems aimed squarely at their largest, most strategic customers.
Absolutely. This is the multiplier engine. They recognize that for huge companies undertaking major digital transformation, especially with something as new and potentially pervasive as AI agents, the number one priority for the CEO and CFO is cost predictability. They hate surprise bills based on consumption they can't easily forecast. So the AELA offers a very compelling proposition, a single, flat fee that gives the customer unlimited usage of both Data Cloud and Agentforce, typically for a 2- or 3-year term. No complex metering, no tracking consumption, no limits on how many agents they build or run.
Unlimited usage sounds expensive. What makes this a multiplier deal? You mentioned potential uplifts of 200%, 300%, or even more, rather than just a slightly larger standard enterprise license.
The key is the budget source it unlocks. This isn't typically positioned as just a 10% or 20% increase to their existing software budget line item. When a customer signs an AELA, they're often tapping into a completely different and potentially much larger pool of funds. The budget allocated for digital labor or business transformation. They're essentially buying workforce capacity. They're paying a fixed price for the capability to deploy potentially hundreds or thousands of agent use cases across sales, service, marketing, operations, automating tasks, improving productivity, driving growth. Because that digital labor budget is often separate and much larger than the traditional IT software budget, it allows for a genuine step change in the monetization of that customer relationship, driving those big 2x, 3x, or even higher multipliers on the existing annual contract value.
And are they actually seeing this happen? Are customers signing these AELA deals already?
They said the results were very strong right out of the gate. AELAs only officially launched around mid-July before the Investor Day, but by October, they'd already closed over a dozen of these major deals, and maybe more significantly, they reported having about 150 AELA deals currently in the pipeline being actively negotiated. So, yeah, this looks like the primary mechanism they're using to drive really significant financial acceleration in their biggest accounts.
Okay, so this early success and the AALA pipeline must be influencing where they're choosing to invest now. Given the demand for Agentforce seems real, where are they prioritizing putting their capital?
Well, first, the initial surge in interest was apparently huge. They mentioned closing something like 206 Agentforce deals in just the first 6 days after launch. That immediate demand forced them to really commit to aggressive capacity expansion just to keep up. Beyond just general capacity, they highlighted a few specific high-impact strategic areas where they're doubling down investment. The international public sector market, which is often a huge software buyer. Also, the commercial side of life sciences, where they seem to be making a direct play against established competitors like Veeva by building specialized pharma IP directly onto the core Agentforce platform, and also MissionForce, which is their offering tailored for government and defense agencies.
Got it. Now let's transition to a critical financial metric they focused on heavily as the key indicator for tracking all this acceleration. Net new AOV, annual operating value. This sounds like the number we really need to watch.
Yeah, this one requires a little unpacking, but it's crucial. AOV, annual operating value, is basically their measure of the annualized value of their customer contracts. Net new AOV is simply defined as the total value of new and add-on bookings in a period, minus the value lost to attrition, churn, or downsells in that same period. It's the net change in the overall contract value base. Now, historically, the company had seen its overall AOV growth rate slowing down, decelerating. And a key reason for that was that the growth rate of net new AOV, the amount they were adding each period, net of losses, was often lower than the growth rate of the large existing AOV base. It was acting as a drag.
Okay, so basic math. If the new stuff you're adding isn't growing faster than the big pool you already have, the overall growth rate is going to slow down. To reaccelerate, that net new number needs to start growing faster than the base.
Precisely. And the absolute core financial message from Investor Day was that they've hit, or are hitting, the inflection point. They presented data showing that the growth rate of net new AOV is now crossing over and moving decisively higher than the overall AOV growth rate. This critical crossover, they argued, is being driven by a few things finally coming together. Bookings are accelerating thanks to that new capacity coming online, the AELA model kicking in, the consumption flywheel starting to spin, and even strong growth in the lower end of the market. And at the same time, attrition is decelerating, meaning they're holding on to more of their existing business. This crossover, this net new AOV growth, outpacing overall AOV growth, is the fundamental financial engine they believe guarantees that future subscription and support revenue growth will reaccelerate.
Okay, that net new AOV metric paints the big picture financially. But let's try to ground these huge numbers and concepts in some real-world examples. They shared several customer success stories that really highlight the difference between the pre- and post-agentic world, especially the impact of those ALA deals. Let's start with CaixaBank.
Yeah, CaixaBank in Spain is a fantastic example. They're a huge, long-standing customer, already had something like 38,000 financial services cloud licenses deployed. Very mature, stable relationship. Probably growing steadily, but maybe hitting a bit of a natural ceiling in terms of spending. Then they adopted Agentforce and Data Cloud, initially focusing on their 8,000 remote financial advisors and contact center staff. They got one key agent live, saw great results, and are now in the process of deploying 8 more for different tasks.
And the financial impact of adding Agentforce on top of that already large relationship.
This is where the multiplier effect really shows up. Because they embrace this agentic model, moving towards an AELA type structure, the total value of their relationship with the software company saw a massive jump, a 60% step change, a 60% multiplier in just a matter of months. It perfectly illustrates how Agentforce isn't just about finding new logos. It's about unlocking substantial new value, new spending from their biggest, most established customers by tapping into that digital labor idea.
Okay, next example. Vivint, the smart home and security company. Their stories seem to really emphasize the technical benefit of Agentforce script, that deterministic piece we talked about.
Right. Vivint apparently made one of the biggest early bets on Agentforce. But interestingly, they only did it after running a head-to-head bake-off. They compared building agents on the Agentforce platform versus trying to build similar capabilities themselves, a DIY approach using raw LLM APIs and other tools. The platform approach won, and won quickly. Why? Because the Agentforce team could deliver tangible business value almost instantly. And a key reason was that they could reuse Vivint's 15 years' worth of existing declarative automation, the flows, the triggers, the Apex code they'd already built on the platform for reliable process execution.
So the platform's long history and existing tools for building deterministic, rule-based processes meant the agents they built on top were immediately more reliable and faster to deploy than starting from scratch trying to force an LLM to follow rules.
Exactly. They didn't have to reinvent the wheel for governance and process control. They could leverage the platform's deterministic DNA right away. So Vivint deployed assisted agents to help their human reps, reducing training time, improving call handle times. And they also built autonomous IDA agents for handling more complex customer troubleshooting and even processing payments securely, relying on that deterministic script capability. The lesson was the power of combining AI with reliable execution.
What about a more traditional industrial company like Eaton?
Eaton showcases the sheer scale and speed of adoption once a company commits. They mentioned that since the previous Dreamforce conference, Eaton had identified and started building over 150 potential agent use cases. And remarkably, they already had 40 of those use cases in full production, being performed by just 6 core agents that they had configured. Achieving that required a significant internal investment and commitment, which led to Eaton making a major new financial commitment, a big step change in their spending, just 3 months before the Investor Day. It really multiplied the size of their overall relationship because they were effectively buying productivity and automation capability, not just incremental software seats.
And maybe the most striking productivity stat came from One New Zealand, the telecom operator.
Yeah, that one definitely makes you sit up and take notice. It really highlights the potential efficiency gains from these agents. They deployed an Agentforce agent specifically tasked with a core business goal, convincing existing prepaid mobile customers to switch to more valuable postpaid plans. The results. The conversion rate achieved by the Agentforce agent was 4 times higher than the conversion rate achieved by their human agents doing the same task. 4 times better. Unsurprisingly, based on that result, one New Zealander was reportedly in negotiations at the time of the investor day for a new deal that would basically double the size of their relationship again, driven almost purely by the measurable ROI they were seeing from that single agent.
Wow. Okay, these stories, Kex-Banks multiplier, Vivint's reuse of deterministic logic, Eaton scale, 1NZ's 4x efficiency, they all clearly demonstrate agent force driving significant new value in spending. And this directly pushes back against that narrative we sometimes hear that size is dead, that foundational software is becoming commoditized by AI.
Yeah, the source materials really hit that point hard, and they used a pretty potent piece of evidence to counter the SaaS is dead argument. The irony is quite striking. The very companies building the foundational large language models, the OpenAIs, the Anthropics, the Googles of the world, the ones some critics claimed would replace core SaaS applications. Those companies themselves had actually tripled their own spending on this company's core SaaS applications over the preceding 12 months. That fact alone strongly reinforces the core hypothesis here. You absolutely need those robust enterprise-grade SaaS applications for execution, for data management, for security, for governance, for compliance. LLMs can't operate effectively or safely in a business context without that foundational layer. SaaS isn't dead. It's becoming the essential control plane for enterprise AI.
Okay, so with that confidence in the underlying platform, they laid out a clear path for how they expect monetization to ramp up based on customer adoption maturity. They talked about specific ARR multipliers.
Yes, they defined a kind of journey with expected financial uplift at each stage. So customers moving from just basic adoption, maybe using 3 core clouds, to what they called a pre-agentic stage, which means adopting more clouds, maybe some specific industry solutions, typically sees about a 1.2x ARR uplift compared to the baseline. Then, when customers start adopting Agentforce within the core platform, maybe deploying those assisted agents, the copilots for employees, the uplift, increases significantly, moving into the 1.5x to 2x ARR range.
And the ultimate goal, the full vision.
The final stage is moving customers to become a full agentic enterprise. This means wall-to-wall adoption of Agentforce humans and agents working seamlessly side by side across most functions. Achieving this stage, they project, results in a really substantial 3x to 4x ARR uplift compared to their starting point. And that massive jump is primarily driven by successfully tapping into that new digital labor budget, largely through those unlimited AELA agreements.
That roadmap logically leads into their ambitious long-term financial framework. With these kinds of multipliers in play, what are the big headline targets they're aiming for? What are these agents supposed to deliver financially by the end of the decade?
The main top-line goal they put out there was reaching $60+ billion in annual revenue by fiscal year 2030. And importantly, they specified that this target excludes any potential impact from major acquisitions or divestitures, like the Informatica deal discussed elsewhere, so it's framed as an organic goal. Achieving that $60 billion implies getting back to a 10% organic compound annual growth rate, CAGR, for the periods from FY 2026 through FY 2030. They're essentially betting that the net new AOV inflection point we discussed will successfully reignite that double-digit growth trajectory.
And it's not just about revenue growth, right? Profitability is a huge focus, too.
Absolutely. The other major plank of their long-term financial framework is hitting the Rule of 50 by FY 2030. That's calculated as their subscription and support revenue growth rate, plus their non-GAAP operating margin percentage. Hitting 50 is considered a strong benchmark for profitable growth in SaaS. They did caution, though, that because of the drag from the previous couple of years of deceleration, it will likely take about 12 to 18 months for the current acceleration they're seeing in bookings and consumption to fully flow through and show up in the reported subscription and support revenue growth numbers. There's a lag effect.
And underpinning both the revenue and profitability goals is this intense focus on operational excellence, on becoming a lean agentic enterprise themselves.
Yeah, they stress this quite a bit. It's not just about selling agents. It's about using them internally to become more efficient. This involves ruthlessly prioritizing spending, adopting what they call the beginner's mind to constantly question old ways of doing things, and really committing to being customer zero aggressively, using their own Agentforce products internally to drive efficiency. Examples included deploying their own SDR agents to improve sales productivity and using agents for internal G&A, general and administrative tasks, to reduce operating costs. They pointed out that their operating margins had already nearly doubled over the preceding 5 years through disciplined cost management, and the plan is to continue that focus. They also reaffirmed their commitment to tripling free cash flow over 5 years and continuing to return capital to shareholders, flagging an additional $7 billion in share buybacks planned for the second half of FY 2026. Tag outro.
Wow. Okay, that was a really comprehensive look at a massive strategic and technical shift. I think for me, boiling it all down, the single most important takeaway is this. The real competitive advantage in this new AI era, at least in the enterprise, it doesn't seem to be about who can build the absolute biggest or fastest LLM. It seems to be entirely about who provides the essential platform around the LLM, the secure, reliable, data-connected, and crucially deterministic software layer, like Data 360 and Agentforce script, that's required to actually make probabilistic AI useful, safe, and scalable for real-world business operations.
I think that's exactly right. That's the definitive conclusion from everything we've reviewed. That technical compromise, blending the intelligence of the LLM with the predictable logic of traditional software, seems to be the only viable path for enterprises needing to manage risk and achieve reliable outcomes. It's the governance layer. And it leads to a final thought. That $60 million revenue target for FY 2030, it sounds ambitious, sure. But listening to how they talk about the ALA model and this concept of the digital labor budget pool, if that budget pool is truly as vast and untapped as they seem to believe, and if those 150 AAL deals currently in the pipeline start closing at the multipliers they're suggesting, well, it's possible that the financial acceleration could actually push them past that $60 billion target, maybe even faster than projected. The market's been understandably skeptical for a while, with the whole SaaS is dead narrative. But this strategy suggests SaaS isn't dead at all. It's just evolving into the indispensable control plane for the whole agentic future. So yeah, keep a very close eye on that net new AOV growth line.
That's the real telltale sign of whether this massive bet is truly paying off.
A fascinating final perspective. Okay, thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.